Hello class, let's start with capital expenditure, revenue expenditure, depreciation, single entry system and consignment account. To begin with, capital expenditure. What is the meaning of capital expenditure? The expenditures that are incurred by an organization for long-term benefits are known as capital expenditures. These expenditures serve the purpose of increasing the capacity or capabilities of long-term assets by either enhancing or adding new asset to the organization. These expenditures are added on the asset side of the balance sheet. Capital expenditure is done mostly on assets such as land, equipment, furnishing, or vehicles that help to drive benefits for the organization by increasing the operating capability. Here we understand that capital expenditure is that expenditure which is incurred by the organization, and the benefit that is derived from this kind of expenditure is for pretty long period of time. Example like purchase of land, building, car, etc. Exactly opposite is revenue expenditure. What is revenue expenditure? Revenue expenditure is referred to as the expenditure incurred by an organization to manage the day-to-day functions of a business, which can include employee wages, inventory, rent, electricity, insurance, stationery, postage and taxes. These are the expenditures which are neither helpful in creation of assets nor they help in reducing the liabilities of a business. It is recurring in nature and is very essential for managing or maintaining the daily operations of a business or organization. From this, we understand that revenue expenditure is that expenditure which is incurred by the organization to manage its day-to-day activities or its short-term activities or expenses. What is depreciation? Depreciation is a systematic allocation of the cost of fixed assets over its useful life. It is a way of matching the cost of a fixed asset with the revenue or say other economic benefits it generates over its useful life. Without depreciation accounting, the entire cost of a fixed asset will be recognized in the year of purchase. This will give a misleading view of the profitability of the entity. The observation may be explained by the way of an example. Depreciation is a measure of wearing out consumption or other loss of value of a depreciable asset arising from use, elevation of time, obsolescence through technology and market changes. Depreciation is allocated so as to charge a fair proportion of a depreciable amount in each accounting period during the expected useful life of the asset. Depreciation includes amortization of assets whose useful life is predetermined. From this, we can understand that any land, building, fixed assets are depreciated. If these fixed assets are not depreciated, they may give us a wrong or misleading profit of the entity or say organization. Single entry system. What is single entry system? Actually, single entry system is the oldest and the most straightforward method of keeping record of financial transactions, which is rarely prevalent these days. In this system, one side of the transaction is recorded because of the absence of any prescribed rules, and so the record maintained are more or less incomplete. From this, we understand that single entry system is that system where there is no rules regulations followed, like double entry system, or no proper books of accounts are maintained. It's a raw account which has to be calculated for profitability of the organization. We can say that single entry accounting is a form of bookkeeping and accounting in which each financial transaction is a single entry in a journal or transaction log. As a result, the accounting system is called, not surprisingly, a single entry system. We can also say it as single entry bookkeeping. Consignment account. What is consignment account? We have two persons here, one is consigner and one is consignee. As the goods are not sold to the end customer personally by the manufacturer or say by the person who wants to sell, the uh, the other person appoints an agent to sell these goods. Now, consignment account. A consignment occurs when the owner of goods leaves them with another party to be sold. When goods are eventually sold, the consignee retains a commission and pays the consigner the residual amount. Consignment arrangements are relatively common for certain types of retail sales. Online auction sites are a form of consignment arrangement since a third party is undertaking the sales role. In a consignment arrangement, the consigner continues to own the goods until they are sold, so the goods appear as inventory in accounting records of the consigner, not in the consignee. Consigner and consignee are the two person who plays the character role in consignment account. We can say that consignee and consignment both engage into one small kind of contract, and they keep a small kind of contract to say that they want to sell the goods. Now, who is consigner and who is consignee? Consigner is a person who sells the goods. Consignee is a person who is appointed by the consigner to sell the goods on behalf of him. Therefore, consignee has to sell the goods on behalf of consigner, but he charges commission for that. This way, if the extra commission is charged, is also called as del creditor commission. So I hope it is all followed by your class. Thank you.